The stock market has not been doing well this year, and many people are scared to lose their hard earned money. With inflation at all time highs, what should you do with the money you earn? The mistake that a lot of people make is they store their paychecks in low yielding accounts. Because of high inflation, the value of your dollar becomes less and less. If you're one of those people, keep watching until the end of this video to help prevent loss of money. I'm going to show you 3 places better to store your money than a low yielding savings account. But first, make sure to hit that like button and subscribe to the channel to learn more about money and investing. Online banks are able to offer a very high interest rate because they don't have the physical expenses that a brick and mortar bank has. With an online savings account such as Ally or Capital One, you're able to earn between 2 and 3% interest rate on your money. This is over 200 times a normal savings account would provide, which is around 0.01% or 0.02%, such as Wells Fargo. The best thing about accounts like these high yield savings accounts with Capital One or Ally, you're able to move money in and out quickly and easily, just like a normal savings account can do. As we can see on our screen here, high yield savings accounts such as Ally outperforms many of the traditional savings accounts at other banks. Another option is called Yada Bank, which offers a flat 0.20% interest rate. On top of that, every week they drop prices where you can earn even more interest on your money based on how much money you have deposited. If you use my referral code or link in the description, we both get an extra 100 tickets, which means more money in our pockets. You might not make as much as a high yield savings account, but it is a fun and rewarding way to save. The second best place to store your money would be a certificate of deposit, or CD for short. And you're basically tying up your money for a fixed period of time at a fixed interest rate. And these rates are typically higher than a normal savings account. CDs are available at most credit unions and banks, so they're widely accessible, and they typically have about 1% more interest than a high yield savings account, as we can see on our rates right here. The only downside is your money will be tied up for a fixed period of time, so make sure this is extra cash that you do not need in the short term. And a third best place to store your money than a 0.01% savings account would be a bond. And a bond is best described as debt or an IOU. Borrowers issue bonds to help raise money from investors that are willing to lend to them. In return for borrowing the money, they promise to return the investment plus interest on top of it at the end of the period. Bonds are considered reliable investments and generally have lower risk than stocks. Additionally, the bond market generally reacts inversely to the stock market. So when stocks are going down, the bond market goes up. If you don't want to buy direct bonds, the easiest way would buying a bond ETF, which you can find available through many brokerages such as Robinhood, Vanguard, and Fidelity. I will leave my referral links for Robinhood and Webull in the description below, and we both can get some free stocks for signing up. A bond ETF such as BND is a low volatility ETF that pays out monthly dividends. Because of the monthly dividend payout, it allows your money to compound even faster, assuming you have dividend reinvestment enabled. So overall, you want to move your money out of a low yield savings account into something giving you a little bit more money, such as a high yield savings account with Capital One or Ally Bank, and this will help prevent money loss due to inflation. At the minimum, there is no reason you shouldn't move your money into a high yield savings account because it does the exact same thing a traditional savings account does, but you're earning more interest. If you have a lot of money and you don't need it for a while, a CD would probably be your best bet. If you want to hedge your stock portfolio against a market crash, a bond ETF could help protect your portfolio. Thanks for getting to the end of the video. If you guys have any questions, leave them down below, and make sure you hit the subscribe button and like button if you haven't already.